It does not announce itself with a warning letter. It does not arrive on a Thursday in a registered envelope requiring a signature. This particular trap is completely silent. It operates in the background of your life, invisible, automatic, and mathematically relentless. You do not feel it happening. You do not see it on the surface. But every single month, while you are going about your life, dropping the kids at school, grabbing a coffee, sitting in traffic on the 401, the number on your mortgage statement is moving in the wrong direction, not down. Up. You are paying, you are sacrificing, you are doing everything right, and you are falling further behind with every passing month. Welcome back to Canada Property Watch. Over the past several weeks, we have pulled back the curtain on the machinery dismantling the Canadian housing market piece by piece. We exposed the forensic audits catching fake income documents. We documented the insurance blacklist triggering automatic mortgage recalls. We tracked the white-collar purge emptying the glass towers of Bay Street. Today, we are going deeper into the mechanics of the crisis. Today, we are exposing something that is hiding in plain sight inside the mortgage statements of an estimated 420,000 Canadian homeowners. It is called negative amortization, and it is the financial equivalent of running on a treadmill that is quietly accelerating while you believe you are making progress. By the end of this video, you will understand exactly how this trap was built, who it was built for, and why the people who sold it to you had every incentive to never explain what it actually does. To understand this properly, we have to go back to 2020 and 2021. You remember that era, the Bank of Canada had cut interest rates to historic lows. The overnight rate sat at 0.25%. Mortgage brokers were advertising variable rate products with starting rates below 2%. The pitch was seductive and it was everywhere. Lock in a fixed payment. Enjoy the low rate. If rates go up, your payment stays the same. Stability. Predictability, peace of mind. That was the sales language. What the brochure did not explain in plain terms was the mechanical consequence buried in the contract. The consequence that kicks in when the interest rate environment changes dramatically. The consequence that 3 major Canadian banks now have sitting on their books to the tune of $94 billion. Let us build the profile of a real borrower. Let us call him David. David is 41 years old. He works in project management for a mid-sized construction firm in Mississauga. His wife Linda works part-time as a dental hygienist. Together, they bring home around $145,000 a year. In the spring of 2021, they bought a semi-detached home in a suburb west of Toronto for $980,000. They put down $195,000, a combination of savings and a gift from Linda's parents. That left them with a mortgage of $785,000. Their broker at the time offered them 2 options, a 5-year fixed at 2.1% or a variable rate mortgage with fixed payments at 1.75%. The broker explained that the variable product kept their monthly payment locked at $3,180, regardless of what happened to rates. David and Linda chose the variable. The payment felt manageable. It was less than 26% of their gross monthly income. They felt responsible. They felt smart. They signed the papers on a Friday afternoon and took the family out for dinner that night to celebrate. For the first 14 months, everything was exactly as described. The payment came out on the first of every month, $3,180. The balance on the mortgage crept downward slowly. Life continued. Then in March 2022, the Bank of Canada began raising rates. First 25 basis points, then 50, then 75. By the summer of 2023, the overnight rate had risen from 0.25% to 5%, an increase of 475 basis points in less than 18 months, the fastest rate hiking cycle in Canadian history. David and Linda noticed the news. They discussed it at dinner, but their payment never changed. It stayed at $3,180. And because the payment never changed, they assumed they were protected. They assumed the contract was doing what the broker said it would do, keeping them stable. What they did not know, what nobody sat them down and explained with a whiteboard and a calculator, was that inside that fixed payment, the composition had completely shifted. Here is the mechanism, and this is the part that every variable rate holder in Canada needs to understand with absolute clarity. A mortgage payment has two components, principal and interest. In the early months of David and Linda's mortgage, at 1.75%, their $3,180 payment broke down roughly as follows. Approximately $1,035 went toward interest. The remaining $2,145 reduced the actual balance of the loan. They were making real progress, genuine progress. The debt was shrinking, but as the Bank of Canada raised rates, the interest portion of that fixed payment grew larger. At 3%, the interest component consumed roughly $1,960 of the $3,180. Principal repayment dropped to $1,220. Still moving forward, but slower. At 4.5%, the interest portion hit approximately $2,940. Principal repayment was now only $240 per month. They were essentially treading water. And then the rate crossed what is known in mortgage mathematics as the trigger rate. This is the precise interest rate at which the entire fixed monthly payment is consumed by interest alone. Not a single dollar reduces the principal. The debt stops shrinking. It simply sits there, frozen, while the calendar keeps moving. But the system does not stop at frozen, because if the interest owed in a given month exceeds the fixed payment amount, the shortfall does not disappear. The bank does not absorb it. The bank adds it to the outstanding mortgage balance. This is negative amortization. David and Linda are paying $3,180 every single month without missing a payment, without a single late fee, without any indication from their bank that something is catastrophically wrong. And yet their mortgage balance, which started at $785,000, is now larger than it was the day they signed. The debt is growing, the clock is running, and renewal day is coming. According to data compiled from Canada's major lenders, BMO, TD, RBC, and CIBC collectively reported approximately $94 billion in mortgages that had entered negative amortization territory during the rate hiking cycle. The Office of the Superintendent of Financial Institutions, Canada's primary banking regulator, flagged this concentration of negatively amortizing loans as a significant systemic vulnerability. These are not fringe products held by reckless speculators. These are standard variable rate mortgages sold to ordinary working families by licensed brokers at every major bank branch in the country during the peak of the housing boom. Now let us follow David and Linda to renewal day. Their 5-year term expires in the spring of 2026. The bank's system performs what the industry calls a hard reset. The computer looks at the mortgage file and recalculates everything from scratch. It sees the original amortization schedule, 25 years. It notes that 5 years have elapsed. There are 20 years remaining on the clock. It looks at the current outstanding balance. Because of the negative amortization, that balance has grown from $785,000 to approximately $831,000, more than when they started. The bank then applies the current 5-year fixed renewal rate. At the time of this recording, that rate sits around 5.1% for loyal customers. The system calculates the new monthly payment required to fully retire a debt of $831,000 over the remaining 20 years at 5.1%. The result appears on David and Linda's renewal notice. Their new monthly payment is $5,490. Their old payment was $3,180. The increase is $2,310 per month. That is $27,720 per year in additional after-tax cash that their household budget must now produce. To generate that extra $27,720 in take-home pay, David would need a gross salary increase of approximately $42,000. Did David get a $42,000 raise this year? No. Nobody got a $42,000 raise this year. In fact, David's company lost 2 major contracts in the fourth quarter, and the whispers about restructuring have already started in the break room. This is the trap, and what makes it particularly brutal is the compounding of 2 separate shocks arriving simultaneously. The first shock is the rate increase itself. Moving from 1.75% to 5.1% is painful for any borrower, but for a fixed rate holder who took out a mortgage at the same time, the jump is roughly proportional to what they knew they were accepting when they chose a fixed product. They understood they were betting on rates. The variable rate holder with fixed payments believed they had protection. They believed the fixed payment was a shield. What they did not understand was that the shield was only protecting their monthly cash flow while quietly building a larger and larger debt load behind the scenes. So they get hit with the rate shock like everyone else. Plus they get hit with the balance shock. The extra $46,000 added to their principal means they are paying interest on a larger number at a higher rate. It is a double compounding of pain. The renewal letter sits on the kitchen table. David reads it twice. He calls the bank. The representative is polite and unhelpful. She explains that the payment reflects the outstanding balance and the current market rate. She mentions that the bank offers an option to extend the amortization period to 30 years, which would reduce the monthly payment to approximately $4,680. David does the math. Even the extended option adds $1,500 per month to their budget, and extending to 30 years means they will be paying this mortgage until David is 71 years old. He hangs up the phone. He sits in the kitchen. Linda is at work. The kids are at school. The house is quiet. And for the first time in 5 years of homeownership, David allows himself to think the thought he has been avoiding. What if we cannot actually afford this house anymore? This psychological moment, the moment a responsible homeowner accepts the arithmetic, is what the banking system fears most. For decades, Canadian mortgage culture has been built on a foundation of what economists call debt servitude loyalty. Canadians will do almost anything to avoid missing a mortgage payment. They will cancel vacations. They will stop contributing to their RRSPs. They will take second jobs. They will borrow from family. They view the mortgage as a sacred obligation, a moral contract, not merely a financial one. The banks have relied on this cultural trait for generations. It has kept default rates artificially low even during previous economic stress periods. But every structural assumption has a breaking point, and the negative amortization renewal wave of 2026 is testing that assumption at scale. Because David and Linda are not alone at this kitchen table. The Bank of Canada has estimated that approximately 1.2 million Canadian mortgage holders are navigating renewals in 2025 and 2026. Of that cohort, a significant portion hold variable rate products with fixed payments originated during the 2020 to 2022 window. Many of them are sitting with mortgage balances that have grown, not shrunk, over their term. They are arriving at renewal day with more debt than they started with, facing higher rates, with household budgets already stretched by 3 years of elevated inflation. The math is not close for many of them. It is not a question of tightening the belt or cutting the streaming subscriptions. The gap between their current payment capacity and their new required payment is structural. It cannot be closed by lifestyle adjustments. When a borrower in this position cannot make the new payment, the sequence of events is mechanical and swift. The first missed payment triggers an internal flag at the bank. A collection call follows within days. If payment is not received within 60 days, the file moves to the Special Loans Unit. This is a department that most Canadians do not know exists. It operates quietly inside every major Canadian bank. Its function is to manage distressed assets. The Special Loans Officer is not a customer service representative. They are not there to find solutions. Their mandate is to protect the bank's capital. They review the file. They assess the current market value of the property. They calculate the bank's exposure. And they make a decision about whether to work with the borrower or initiate power of sale proceedings. In a market where property values have declined since the purchase date, the bank's calculation shifts dramatically. If David and Linda owe $831,000 on a property that an independent appraiser now values at $790,000, the bank is already in a technically underwater position. They are not waiting. They are not negotiating. They are moving to recover their capital before the market declines further. This is not malice. This is math. The bank's fiduciary obligation is to its shareholders and depositors, not to David and Linda's family stability. What can a borrower do if they recognize themselves in this picture right now, before the renewal letter arrives? The first and most important action is to contact your mortgage holder today and request a full amortization schedule. Ask them to show you your current outstanding balance, your trigger rate, and whether your mortgage has entered negative amortization territory. You have the right to this information. It is your contract. Many borrowers have never asked this question because the fixed payment created an illusion of normalcy. The illusion needs to be shattered now while there is still time to respond. If your balance has grown, you need to understand your renewal options before the bank presents them to you on their timeline. Get an independent mortgage broker to model multiple scenarios. What does a 20-year amortization look like at current rates? What does a 25-year look like? What is the payment difference? Can your household income support the higher payment? If the honest answer is no, you are better served by making a voluntary decision to sell the property on your own terms rather than allowing the bank's timeline to dictate the outcome. A voluntary sale gives you control over staging, pricing, and closing date. A power of sale gives you none of those things. Second, do not confuse the extended amortization offer with relief. When a bank offers to extend your amortization from 20 years to 30 years to lower your monthly payment, they are not doing you a favor. They are protecting their performing loan statistics while transferring the long-term cost burden onto you. An extra 10 years of amortization on a balance of $831,000 at 5.1% represents approximately $190,000 in additional interest payments over the life of the loan. That is money that will never build equity. It will never fund a retirement. It goes directly to the bank's income statement. Understand what you are accepting before you sign the renewal. Third, if you have a variable rate mortgage with fixed payments and you have not yet hit your renewal date, call your broker this week and ask for a trigger rate calculation. Ask them to calculate at what interest rate your current fixed payment no longer covers the interest portion of your loan. If the current rate is at or near that trigger point, you need to know. Some lenders have been proactively notifying borrowers. Others have not. Do not wait for the letter. The negative amortization trap was not designed maliciously. It was designed during a period when the assumption was that interest rates would remain low indefinitely. The product made sense in the world it was built for. But the world changed with extraordinary speed, and the borrowers who trusted the system, who followed the advice of licensed professionals, who signed contracts they were told were protective, are now absorbing the consequences of an assumption that proved catastrophically wrong. The system did not warn them when the trigger rate was crossed. The system did not send an alert when the balance began growing. The system sent nothing. It simply kept processing the fixed payment and adding the shortfall to the balance, quietly, automatically, every single month. There is one more dimension to this story that we will be investigating in our next report, and it connects directly to what we are seeing in the luxury market right now. When a high-income professional, a banker, or a technology executive loses their job and simultaneously faces a negative amortization renewal shock, the forced sale that follows does not happen in isolation. It sets a comparable sale price that the bank's algorithm uses to reassess the collateral value of every similar property in that neighborhood. When that reassessment triggers a HELOC freeze for the neighbors, and it will, the ripple moves outward. In our next investigation, we are going to follow that ripple and show you exactly which postal codes are at the epicenter of this contagion and why the power of sale listings you are starting to see in certain neighborhoods are not the peak of this wave. They are the beginning of it. Subscribe to Canada Property Watch. We read the mortgage contracts the brokers summarize. We pull the regulatory filings the mainstream media ignores. We do the amortization math your bank hopes you never run yourself. The renewal wall is not a future event. For 420,000 Canadian households, it is the present. Check your balance, know your number, and do not let the silence of a fixed payment convince you that everything is fine.